Willie, one of the things I see in this market right now is just about every sentiment measure you can find at or near their all-time highs. And I'm looking at this market, and we just had an incredibly impressive month of November, but if you move those goalposts back a few months, we're flat. So how's the engine working right now? Is it firing off on all cylinders, or is it taking a lot to move it? The NASDAQ, we're up 1% after all the legwork here.
Yeah, I think it's an interesting thing to consider right now, the tension between what you say in terms of optimism and the sentiment that looks a little frothy and seems like you're not really getting a lot overall for all the work that's being put in. But then you look at the broad market, and so don't just look at the NASDAQ and the S&P 500, but look at small caps, for example, look at the median stock, look overseas, and you're seeing a tremendous rotation. Yeah, it's a little ahead of itself from a sentiment perspective, but the breadth of the rally right now is really, really impressive and really encouraging for what lies ahead in 2021.
Willie, what right now is the most encouraging signal that you see? I know that you track a lot of these on your own. You look at a lot of research reports. Is there something that screams out, hey, every time this happens, every time X happens, Y happens, Z happens, we can expect this over some 6-12 month horizon? What's the most bullish metric out there right now?
Well, I'll give you two of them. One, it's the breadth thrust that we saw earlier this year, and then we saw it again this summer. We can see the percentage of S&P 500 stocks trading above their 50-day averages spiked above 90 earlier this summer. That typically provides a tailwind for up to 6 to 12 months out there. And then you look overseas and you see that 90% of international markets are trading above their 50-day moving averages, and expanding number of them are trading at not just new 52-week highs, but new all-time highs. So they're taking out those peaks from early 2018. And so when you put that all together, it suggests to me that for all the noise, for all the volatility, this bear market that we've been in globally since 2018 might be coming to an end, and we're at the beginning of a new leg higher, not at some sort of exhausted extension of a previous rally.
So, Willie, I think this is interesting because we're broadening out our conversation from very U.S. domestic centric. And this is a theme that I've noticed with some of our guests. We talked about Jeff Kleintop this morning from Schwab, basically making this similar type of case that some of the other non-U.S. markets could do really well in this recovery. What I'm curious about is, for so many investors that are piled in still to very big cap weighted funds, then what does that look like? Because right now I see tons of ETF money coming in here. Flows at records. We just set new all-time records for ETF flows. Bank of America's fund manager survey shows cash levels are near their lows. So for U.S. domestic market cap weighted indexes, where's the incremental money going to come from if you don't want to take it out of the international stuff that's supposed to do so well right now? Where's it going to come from?
Yeah, that's a good question. I think what you actually get is not new money coming in at this point, but rotation from some of that big cap U.S. fund money has to start to roll into mid caps and small caps and starts to roll overseas. There's a reason that U.S. investors particularly are piled into U.S. big cap funds, because over the past decade they've led consistently. I think that's at an end, and so we start to see a protracted rotation away from S&P 500 based funds to things again smaller in the cap spectrum, and then also starting to look overseas again, whether it's developed markets or emerging markets. I think the name of the game is diversification after a decade of just putting all your eggs in a U.S. basket.
Does that mean that we should think about the NASDAQ as having sort of a slower upside potential for momentum? Is it capped? Is this a range-bound market despite how much everybody expects the economy to start booming right now? Do we have to separate the potential for economic boom from the market cap index boom?
I think that's exactly right. I think we need to separate, realize the separation there, and realize the NASDAQ boomed this year when the economy wasn't doing well. That's the money that that had no place to go and was just, going into stocks for could say no good reason, but because it had to go somewhere.
Sure.
Now, as we start to think about a more dynamic economic situation and a more globally diverse, opportunity set, then the NASDAQ and to some extent the S&P 500, I think are capped to some degree, and definitely give up relative leadership to other areas of the market that, for a while have underperformed pretty consistently. I think that changes going forward.
We were just looking at the chart from Ned Davis Research that shows that ETF flow is picking up. It's actually gone up even more, as that one didn't include the last couple days of November. So I know that according to Morningstar, we're now at the highs, really only comparable to 2018 before we had that weird VIX moment and the NASDAQ rolled over. But if we take your point here about rotation and kind of say, okay, well, if we move away from this kind of market cap, tech-heavy NASDAQ, then where else? You look at the value line geometric index. I think this is a pretty interesting way to consider the market from a different perspective. What does it tell you right now as we come up on potentially breaking out?
Yeah, so just to back up for those that don't follow the value line geometric index, it's my favorite. I understand it's maybe not other people's favorite. It's the median stock in the value line universe. And what's interesting for me is that, one, the peak earlier this year did not surpass where we were in 2018. So that this is consistent with kind of a narrow bull market that was existing just in U.S. large caps. And so we sold off, and now we're testing those levels. And if we get through that, that says again that you've got not just a mega cap led rally, but you've got a very broad-based rally in the U.S. that confirms what we're seeing overseas in terms of breakouts to new highs. This really becomes a much healthier market when you have a wide variety of stocks and types of stocks and sizes of stocks and geographies participating in a rally. That's a healthy development and suggests that this environment that we've seen over the past couple years of very narrow leadership, of talking about the FANG stocks or some iteration of that, starts to be a story of the past, and it becomes economically sensitive areas starting to do well as the U.S. and the world look towards economic recovery after this year's recession.
Willie, in your mind, does non-U.S. investment mean other developed markets that have lagged behind? Does it mean China? Does it mean as far down to emerging markets or frontier markets?
Yeah, I think you can look at all of those areas. All of those areas are doing well right now. I think emerging markets are a particularly interesting area to look at. They give you some opportunity to start to show leadership relative to the S&P 500. That's what the chart you're showing right now shows, that after 10 years of doing poorly relative to the S&P, now is a time that emerging markets can start to shine. Copper is breaking out to the upside. Typically, copper is a good indicator for what's going on in emerging markets. If that can continue, then that would say emerging markets are good, not just on an absolute basis, but on a relative basis relative to the S&P 500. And I think the important thing is to step back and say, over the past decade, diversification has hurt most U.S. investors, if you think about it geographically. Yeah. What's diversification supposed to do? It's supposed to lower risk and increase return. It's done the opposite of that over the past decade. I think this is a chance to start to correct that. Reversion to the mean, whatever you want to call it. It's an opportunity to start to actually gain some benefits from diversification again.